The Mag 7 is considered the barometer for the tech industry and really the market overall in 2025. But these stocks are not all created equal, and they're not going to perform equally in the future. I want to rank them 1 through 7. And I want to ask you what your opinion is too. If you have thoughts on what your favorite Mag 7 is stock, all the way down to the 7th, put those in the comments section below. I'm interested to see if your list looks similar to mine. But let's start off with some basic valuation metrics to just kind of set the playing field. The price to sales multiple, I think, is something that's very valuable to look at with a lot of tech companies, because that kind of pulls out the profitability, some of the short-term impacts that can happen with that. There is one major outlier here, and that is NVIDIA. But that makes sense because NVIDIA has incredibly high margins in their chip business. So that one may not be all that surprising. Amazon, also not all that surprising that they have the lowest price to sales multiple at just over 3. Microsoft and Tesla, leading the other two, may actually hurt their valuation going forward, but I'll get to that in just a little bit. Let's also look at the price to earnings multiple. This is where you see a huge outlier in Tesla. They're just not all that profitable anymore. Given the fact that sales for their vehicles fell 50% in Europe just in the month of April, I wouldn't be surprised if we see more weakness in Tesla's profitability that could make that PE go up or even essentially disappear if their earnings go negative. The cheapest stock on a PE ratio basis is Alphabet. I think that's really surprising because the market obviously doesn't think that the search business and the advertising business is going to be as strong in the future as it has been in the past. I'm going to dig through all that. I will put my rankings in the timeline below if you want to skip forward to any of these and hear my thoughts on each one of these stocks. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And of course, subscribe to my newsletter, Asymmetric Investing. That's where you're going to get more analysis, including deep dives on every single stock that I buy. And each month, I'm putting money into what I call the asymmetric portfolio. That portfolio is absolutely crushing the market, and I will have my next buys out at the beginning of June. So check that out if you're interested in more analysis from me. And thanks to this video sponsor, FinChat. You're going to see FinChat throughout this video. This is a tool that I use all the time. I use it for screeners. I use it for detailed analysis. And I use it for their KPIs. That's really the advantage of FinChat. They've got these phenomenal key performance indicators, allows you to dig into a company and what really drives their results. You'll see this with a company like Alphabet. How much revenue are they generating from Google Cloud? What's their margins? Or you could look at Tesla. What's happening with their vehicle sales? Are they declining right now? And why is that the case? FinChat's going to provide details for thousands of companies all around the world. And if you go to finchat.io/ASYM, they're going to give you 2 weeks of the pro version for free, and then 15% off if you decide to become a paying customer. I'm a paying customer of FinChat, have been for a couple of years now, so I'm putting my money where my mouth is. I think this is the best tool that is available. And they're now adding artificial intelligence tools to transcripts. So you don't even have to read a whole transcript or listen to a full conference call. You can just ask an AI questions about what's going on. So really a phenomenal tool. I recommend everybody check that out if you're into fundamental analysis. But let's go to the top stock that I think is in the Mag 7 today. That may not be a surprise to you. That is Alphabet. And I think when you look at Alphabet's numbers, it's just too good to pass up at this point. Their market cap is $2.05 trillion. But when you include their cash that's on the balance sheet, the enterprise value, a little under $2 trillion, price earnings multiple, 18.8 on a trailing basis, and on a forward basis, 18.3. But remember, Alphabet has been surprising analysts with how profitable, particularly their search business has been. So let's dig into some of those numbers, because I think that's really the story, is that a lot of people think that search is really in trouble, but we're not seeing that in the numbers. And that's where we can go into these segments and key performance indicators. And I'm going to just pull up Google search and other revenue. And we'll look at trailing 12-month numbers. What you see here is just steady growth through basically March 2022. This is actually when Apple instituted their app tracking transparency policies. So that basically broke the tie between somebody clicking on a link on an Apple device and knowing whether that conversion happened. That really affected a lot of advertisers like Meta, like Alphabet. And that is why revenue stagnated for a little over a year here. But that revenue started to grow again mid-2023. Now we're seeing consistent growth over the past 12 months. So a year ago, $180.8 billion worth of trailing 12-month revenue in the search business, now $202.6 billion worth of revenue. So we're not seeing a lot of signs of this being disrupted by artificial intelligence or products like ChatGPT. In fact, probably more likely that Alphabet is going to disrupt itself by including a lot of these artificial intelligence tools into the search bar. But let's look at 3 other really key segments for Alphabet. In orange, you have network revenue. This is basically their legacy network business. This is a shrinking business. You can see that a couple of years ago doing about $32 billion worth of revenue per year. That's now down to a little over $30 billion. This is going to be the ads that you see all over the internet. And it has a little spot in it that says advertisement by Google. This is what helped power the monetization of a lot of publishing businesses. But that business is obviously in decline as search becomes more important. And a lot of that advertising spend goes on to platforms like Meta, platforms like Amazon. That's where advertisers are finding their customers today. So that's kind of a declining business. No real surprise there. In purple, you have YouTube. YouTube is growing in double digits, just another phenomenal business that, again, was hurt by the app tracking transparency changes from Apple. That's now growing again, $37 billion. This is just the advertising segment for YouTube. This does not include premium subscriptions. When you add that in, they have said that that's over a $50 billion business, although they don't report the full YouTube revenue or the profitability of YouTube. So on a revenue basis, YouTube is actually bigger than Netflix today. I think that surprises a lot of people, but we don't know exactly how big and how profitable the entire business is. But I think just phenomenal tailwinds behind them. And then in green, we have a segment that you may not really realize is as big as it is. That is subscriptions, platforms, and devices. This is things like the Google Play Store. This is YouTube TV. This is the G Suite. All kinds of products fall under this. I think this is where we're going to see a lot of growth from a lot of their artificial intelligence subscriptions and the monetization that's going to go potentially from advertising to some of these subscription services. And that hardware business, whether that's Alphabet making their own hardware or becoming a platform and then monetizing through things like the Play Store or other platform fees, these are going to be phenomenal ways for them to grow. It's now a $42 billion business. So search is an important business. Let me stack that in here. Search is still the biggest business, but these are a couple of other big growth businesses that are also driven by advertising. I don't think they're going to go anywhere. The other one that we need to keep in mind is, of course, Google Cloud. Google Cloud is a 35% compound annual growth rate business since September of 2020. That slowed just a little bit. I think it was 28% in the most recent quarter. But now look at just how profitable it is. This should be a 20 to 30% operating margin business. We are not quite there yet. They're still a little under 20% on their operating margins, but phenomenal growth for Google Cloud and great profitability. This is where you're going to see the most impact from artificial intelligence and the APIs and the developers that are building on top of the Google Cloud. So when you see Microsoft Azure being a growth driver or Amazon AWS, this is the third place cloud, but it is a very, very fast growing business and getting much more profitable with Alphabet's TPUs, their Gemini models, and everything they're doing in robotics, and even things like their XR platform with Android. I think we're going to see great growth for the next decade or two, potentially from Google Cloud. This is leveraging investments that they've been making for decades in just taking those milliseconds out of the search time it takes to complete a search. Now that's starting to be monetized through the cloud. So this is why this is the top stock for me in the Mag 7 today. Number 2 is Meta Platforms. Again, a stock that has done phenomenally well. Look at this. In 2022, November 2022, the stock was down to about $90 per share, now up to about $670. $1.6 trillion market cap. The price to earnings multiple on a trailing basis, about 24.5, about the same on a forward basis. They are investing a lot of money in artificial intelligence. I think they're clearly lagging Alphabet in that respect, but they do have the monetization tools on their platform. So their family of apps. Then you have a lot of optionality with their metaverse products, everything they're doing in AR, VR, XR, however you want to lump those things together. Those are all really optionality for growth in the future. But when you look at the revenue and net income trends, this is where I think you see just phenomenal performance by Mark Zuckerberg and team at Meta. Look at the margins, now up to $66 billion worth of net income over the past year on $170 billion worth of revenue. So as the company grows, it's actually getting more and more profitable on an operating income and a net income margin basis. Here's going to be the one flaw for Meta is that they are losing a ton of money, about $18 billion per year on their Reality Labs. And the real moneymaker is their family of apps. So if this ever turns positive and they're able to make money being a platform for VR and AR devices, those AR glasses that were shown off about a year ago, that could be another growth driver for the company. But right now, I think the way to look at their profitability is in the core business. And I think that's really stable because they have become a go-to platform for advertisers. They just know how to monetize really well, especially on platforms like Instagram. So I don't see this company going anywhere anytime soon. I see it just continuing to get stronger because those apps and the family of apps, the network effects they have are just too good to ignore. Speaking of a leader in their space, NVIDIA continues to be a phenomenal performer with their dominant position in artificial intelligence. The one thing that gives me a little bit of pause is their valuation. I'll get to why that is in just a second, but PE multiple 44.7 on a forward basis. PE multiple is about 31.5. $3.2 trillion market cap. So just think about that. Alphabet trading for under 20 times earnings has about a $2 trillion market cap. The company that's just providing chips to Alphabet and to all these other big tech companies has a $3.2 trillion market cap. That's what generally gives me pause. But it's hard not to look at this chart right here. This is their data center revenue. Let me just pull up the trailing 12-month numbers. You can see how much of a hockey stick this has been since the ChatGPT moment late in 2022. That demand for chips just absolutely exploded, now doing about $115 billion on a trailing 12-month basis. But this is where I pause just a little bit. Their growth rate is slowing. Still a phenomenal growth rate, 114% growth rate over the past 12 months. That is just enormous for a company of this size. But when you have NVIDIA shares trading for enterprise value to sales right now is about 24, that is a very, very high multiple. That means that a lot of growth is already priced into the stock. If we look at these numbers on a quarterly basis, it becomes a little bit more stark. We're over 200% growth here for a few quarters, and we're now down to about 77% growth in the most recent quarter. Here's the other thing. Let's get rid of the growth rate and let's move this up a little bit so we can see the trend for margins. Margins peaked in the April 2024 quarter. Those have come down pretty sharply, both gross profit margin, which is in orange, and then operating margin, which is in purple. If we zoom way back, you can see that margins are just typically not this high. Typically, your margins are going to be more in the 50 to 60% range for gross profit and 20, maybe a little bit over 30 for an operating profit. They are well above that right now. Questionable whether that's going to be continuing in the future. We've started to see a lot more competition. We see TPUs from the Google Cloud. You have Amazon developing their own chips with Inferentia and all kinds of other chips. They can operate those at a much lower margin because they don't have to make margin on the chips themselves. So they don't have to be as efficient or quite as good. And then you have more competitors coming into the space like AMD. Basically, everybody would like to take the value that NVIDIA has currently from their GPUs and just not have to pay that to NVIDIA to lower their costs a little bit. We'll see if that happens, but I think that's going to be the pressure. So we're still paying a pretty high multiple, but it's hard to keep NVIDIA out of the top 50% of the Mag 7. So that's why I have them number 3. Number 4 is Microsoft. Microsoft, again, phenomenal position, especially in the enterprise business, $3.35 trillion market cap. Price earnings multiple is getting pretty pricey though. You can see that their growth maybe doesn't justify the same high multiple that you get from NVIDIA. That's why I have them ranked a little bit lower. Price earnings multiple on a forward basis is still about 31. So pretty high multiple for them any way that you look at it. And their growth rate is okay, but their growth rate is coming down 14.1% over the past 12 months. That's only slightly higher than Alphabet's growth rate of 13.1%. And the question is, can Microsoft squeeze more and more out of its enterprise customers? I think that's really something they've done a phenomenal job of over the past decade or so, but there may not be a lot left to squeeze. That's why they're pushing into things like cloud with Microsoft Azure and their partnership with OpenAI. But again, they're going to be heavily reliant on OpenAI for their partnership and the revenue that they generate from running OpenAI's clouds and their products on Microsoft Azure. Without that partnership, Microsoft would look like it's in a much weaker position. So given the valuation, given the relatively meager growth rate, I just don't see a reason to be particularly bullish on Microsoft today. I think the market's thoughts that this is a leader in artificial intelligence probably isn't really the case. They're not making their own models. They don't have their own chips. They're really basically a commodity supplier in the AI space. And the fact that they have that partnership with OpenAI doesn't necessarily mean there's going to be a ton of value from that in the future. OpenAI is trying to figure out ways to have other cloud providers and also now move into hardware. So we will see how that all plays out, but I don't think they're in nearly as strong a position as a company like Alphabet, especially when it comes to artificial intelligence. So that's why I've got them ranked much lower. Another one that may be surprising, but comes down to both value and strategic positioning, is Amazon. Amazon, a little over $2 trillion market cap. Price earnings multiple, pretty high though, 32.7, 31.8 on a forward basis. So analysts aren't expecting a lot of growth in earnings per share. Again, this may seem surprising, but not a high growth stock at this point. 10.1% growth rate, so much more expensive than Alphabet, but not quite the same margins because you have a big retail business and growing more slowly. But here's the number I wanted to highlight. This is their net income is in yellow, and then blue is their advertising services revenue. So advertising services is going to be the revenue that they generate to basically push companies to the top of the search bar when you're looking for something on Amazon. So did somebody pay? This has a little bit of text that says sponsored. So if you look for Kleenexes, let's say, you're going to maybe get a sponsored product before you get the product you actually searched for. That is advertising revenue for Amazon. The reason I think this is important is that revenue is what has driven their profitability, because that's a very, very high margin piece of revenue. It also deteriorates their experience. I think that's really the key here, is that if you have noticed that the Amazon search experience and the Amazon retail experience in general is just deteriorated over the past decade, that's why they're pushing more into advertising. So it's not about being the best product for customers. It's how do we squeeze more money out of those suppliers? And being a third-party supplier business, a marketplace, means that Amazon is reliant on suppliers for their product. Amazon is no longer buying inventory the way that they once were and being the retailer itself. They are relying on inventory from third-party sellers. They get tons of fees from those. So they're going to generate nearly half of their revenue because they're going to have to pay to have product in Amazon's warehouses. They're going to get a charge a selling fee. Then you have advertising fees. So Amazon's still going to make a lot of money on every sale for retail, but it's going to deteriorate that experience. And they're going to lose control of exactly what's going to be in inventory. That's why I think you're just not seeing the same products that you used to see on Amazon. Still the best place to go for random products that you're not going to be able to find in a retail store down the street. But it's also going to have a lot of junk in there because these companies are playing the arbitrage game, trying to rank higher up in certain search terms with this advertising revenue. So something to think about. I think that is really what deteriorates the retail business. AWS also kind of missed AI early on, so they're kind of playing from behind. So you add those two things together. I just don't like the strategic position for Amazon today. Doesn't mean they're going to be disrupted. This is a company that just has too much infrastructure to overlook, but want to get it for a really great price, and we don't have that price today. Now, two stocks that I would absolutely stay away from. One of those is Apple. This may sound surprising. Apple has a nearly $3 trillion market cap, obviously has a dominant position in the smartphone market. But look at this price to earnings multiple. It's over 30, 26.9 on a forward basis. This is even after shares have fallen from over $250 per share to under $200 per share as I'm recording. But look at these revenue trends. This is the iPhone in blue, the Mac in orange, the iPad in purple, and the wearables, home, and accessories in green. You can see that revenue for these hardware segments peaked in September 2022. These are trailing 12-month numbers. They have been in decline ever since, a little bit of a bump over the past year or so, but you would not call this a growth company. The only segment that's growing right now is the services revenue. Services revenue is going to be the 30% fee that they get for all the purchases that are happening on iOS devices. But the big piece of this, somewhere between $20 and $30 billion of basically pure profit, is going to be the revenue share that they get from Google being the default search engine on iOS and on Safari on Macs. That is a huge reason that this segment continues to grow. It's a huge reason services are still very profitable. And guess what? Who is generating that revenue to start with? Alphabet, the company that I talked about earlier. So Apple is actually reliant on Alphabet for most of its profitability in its only major growth segment. I think that's a very weak strategic position. Then you have everything with artificial intelligence. Apple has essentially missed AI. If you have experienced Siri anytime in the last decade, it's just an awful product, especially compared to some of the products that are already out there today, including just talking to Gemini in the Gemini app. So I think you look at the future, I would much rather be Android and Alphabet running the Android platform rather than Apple trying to make Siri and iOS a little bit better, something that they're just not built to be an artificial intelligence company. So I think they're going to really struggle in the future. Still very highly valued because people are still going to be buying iPhones, but paying 30 times earnings for a company that really has no major growth prospects right now, I think is a really tough look. But speaking of not growing, the one company that is shrinking right now in the Mag 7 is Tesla. That is likely to continue again in the second quarter, but still has a $1.1 trillion market cap. I mentioned this very, very high price earnings multiple earlier. And they also have one of the highest enterprise values to sales multiple. So this is a hardware company, an automaker that has a very high enterprise value to sales multiple. That just doesn't make sense because typically automakers are going to trade for 0.2, 0.3 times sales. Tesla is trading at more than 30 times that. But even when you just look at their numbers, these are all trailing 12-month numbers. So in red, you have revenue. You can see that their revenue is now in decline. Over the past 12 months, revenue is down. Net income is dropping like a rock. They made $15 billion in 2023 in net income. That is now down to $6.1 billion. Could potentially go negative in the second quarter. And then if you look at their revenue change on a quarterly basis, each of the last two first quarters down in revenue overall. So why is revenue down? Well, you can see that there's a huge decline in deliveries. I mentioned that these KPIs are really valuable. This is one that I look at on a regular basis. When you look at Tesla, in just the most recent quarter, 337,000 vehicles delivered. That is the worst quarter that we have seen since the September 2022 quarter. So demand for Tesla's vehicles is on the decline. At the same time, the price per vehicle is also in decline. That is in red here. These are custom KPIs that I've made, but that's down from over $54,000 per vehicle to $41,500 per vehicle in the most recent quarter. The profit per vehicle down by 2/3. They were making $13,628 per vehicle in gross profit in the September 2022 quarter. That was down to $4,289 in the most recent quarter. So just a massive drop off in their financial performance. Their one growth segment is energy generation and storage. What's happening in that segment? Well, you have most of those batteries are actually coming from China. Those are going to be hit with huge tariffs, 30% as I'm recording today, but could be potentially higher than that later this year. You also have threats from the bills passing in Congress, the big, beautiful bill. This may be a reason that Elon Musk is pulling back from his dealings in the government, is that it's not really paying off. They're taking away a lot of the subsidies that have really helped this energy business become profitable. And also potentially the regulatory credits are going to be under pressure, especially in the state of California. They're trying to take away California's ability to have the zero emission vehicle credits on top of taking away the $7,500 electric vehicle tax credit. So the EV business for Tesla not doing particularly well right now. I mentioned that sales are down about 50% in Europe in the month of April, down by about a third in the first 4 months of the year. And now we may see pricing pressure get even worse in the US if some of those subsidies are taken off. I just think Tesla's in a very, very weak position. They are relying on FSD and robo-taxis becoming a huge business. But guess who's leading that business? Alphabet and Waymo, doing about 250,000 rides per week. They are the clear leader. They have passed regulatory muster in multiple cities and states. Tesla has done none of that. You also have the Optimus robot that Elon Musk thinks could be worth trillions of dollars. But there's, again, a lot of competition in that segment. And we don't know what demand will look like for humanoid robots in the future. So a lot of questions for Tesla, but investors are paying a lot for the stock today. That does not provide upside optionality. That provides downside risk for investors who are buying Tesla today. So that's my list in the Meg 7. Let's go through those again. Number 1 is Alphabet. Number 2, Meta Platforms. Number 3, NVIDIA. Number 4, Microsoft. And then Amazon, Apple, and Tesla. How would you rank the Meg 7? Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing both here on YouTube and my newsletter. Again, the Asymmetric Portfolio absolutely crushing the market. So if you're interested in market beating stocks, check that out. And of course, check out FinChat, finchat.io/ASYM. Phenomenal tool. So hopefully you've enjoyed seeing a little bit of the behind the scenes on how I use that here in this video. So lots of things to check out, everybody. Thanks for watching, and we will see you here next time.